Let's go. Let's do this. Okay, folks, welcome to Thursday Night Stock Charts Live. This is Bob Desmond of the Contrarian Trader. And what we're going to talk about tonight is this. Besides the weekly charts that we're going to go over, we're also going to go over the question of whether or not we are ready to invert yet again on the yield curve. So, a lot of charts coming up, a lot to talk about. I think that it's going to be a great session tonight because ARL. That's the best. I was just about to say this is going to be a great session because I already had a like before I went live, and I have to bet it was RL that did that. That's outstanding. Evening all, remember the like button. Yes, thank you very much. Appreciate that, RL. Remember that like button. Help me out with the YouTube algorithm. And hey, Patrick, RL, great bags you got there. Patrick sent me, as you remember, sent me a couple of photos of some deer that he bagged, and congrats on those, Patrick. And we're going to just dawdle along here for a moment as people come on in. There we go. It's starting to populate now. All right, good. Okay, so what we're going to do tonight is, again, we're going to talk about the how we appear on the weekly charts, how we appear to be setting up, closing out the week, what's going on with the potential yield curve inversion yet again. 40,000 Headman, haven't seen you in a while. How you been? Sell Mortimer. I know that movie. Trading Places. I saw the one with the photos, Patrick, of the deer. If you sent me one in the past hour or so, I definitely didn't see it. Got a phone call coming in. We'll send that to voicemail. Okay. All right. So we have a whole bunch of viewers on now. Good. Uh, let's begin with a headline that came out today because I think it's appropriate that we talk about the markets today. I mean, a lot of volatility out there today. I mean, nothing was working. You had gold down. Everything was under pressure today. Amid record positioning, something snapped in the short vol to zero trade. You know, volatility is the most heavily shorted that it's ever been. There's a lot of complacency out there, and that sets the stage for a potential major league sell-off in this market. And you have the FX market. Well, the dollar rallied today. I don't know what they're talking about here. I didn't read the whole article, so I'm cherry picking some headlines here. Equity and gold under pressures. The volatility index, yes. So a lot of VIX options, futures options, speculative position, record short levels here. This is what I was talking about earlier. So this sets the stage for a major rally in the VIX, a short squeeze like you've never seen before, or you have seen before, but it goes back a long while ago, and that means not good stuff for the stock market. That's why what we want to do right now is take a look at how we are getting poised to close out the week and how we want to position ourselves into the close. What are we going to be looking for? And how we want to position for next week as well. At 7 p.m. Eastern Standard Time, we're going to have a members private group session. So please, members, expect an email immediately after this commentary. I want to go here until about 6:30, 6:35, so I can get that other link out because usually it takes me a few minutes to reconfigure the live stream, and I'll get that out to you. And we have a bunch of people in here now. Good stuff. Let's get to it. I want to kick things off. Since we're talking about volatility, gold and the miners had a rough day today, and you can blame it on the dollar, but I'm not going to do that. I don't believe it was because of the dollar, because the reason why the dollar rallied was because you have more indecision out of China about whether or not we're going to have a trade deal. And you normally see trade and the U.S. dollar rally in tandem. Like in 2018, you had a tick-for-tick inverse correlation of the U.S. dollar and gold. 2019, not so much. So what I wanted to do, since we were talking about the VIX, is take a look at gold on there from a gold VIX perspective. And you can see that the gold VIX, many of you aren't familiar with the fact that there is a gold VIX out there. I'll pop this symbol into the, this is for stockcharts.com anyway, the box. And we'll take a look at the weekly chart of the gold VIX. And the thing that I found interesting is that despite the fact, you'll see that overlaid here is the price of gold, overlaid in gold on the line chart, and in candlestick is the gold VIX. And what we have so far this week is an indecision bar. And an indecision bar is similar to that of a doji star formation. It's just that. It's an indecision. There's a tug of war between bulls and bears. Which way are we going to take gold? Are we going to break out? Are we going to break down? Case in point, you had the gold miners, which broke out the day before yesterday. What did they do today? Breakout point failure. They pulled back and broke down today. A lot of indecision out there. Patrick, NUGT going down. Okay, I expect my call options to expire worthless. Fair bet. I think you sold what, the 2850s, Patrick, or 2650s? Something like that, right? In the neighborhood. I had the 40 strikes expiring into December. So it sounds as if you made the wise call here. I was a little bit more conservative with that trade for this week. I thought we were breaking out. And we did, but we gave it all up today. So the gold VIX weekly basis is flashing an indecision bar. A lot can happen between now and Friday's close. So this is just a pulse check of how we're appearing to be setting up at the end of the week. Now the chart of gold, I'll go to that chart in a moment, is not looking wonderful on a weekly basis. But again, that could change overnight with just simple headlines that are crossing over that are moving the market. So with this, let's segue over into the weekly charts of we'll begin with the yield curve. And the yield curve, I'm going to go over two charts. The yield curve of the 3-month bonds, and then we'll go over the 2s versus 10s. And the reason why this is important, I really don't use this chart all that much, but a lot of the headline the pundits out there will cite for clickbait the 3-month yield curve, the shorter duration yield curve. I like the longer duration. And you can see that while over the summer, we had inverted on the yield curve. This is a monthly chart. Yeah, monthly chart. We had inverted over the summer. We went negative, meaning shorter duration bonds were paying more in yield than longer duration bonds. Not supposed to happen. Very, very negative. And since the Federal Reserve has been very, very active in the markets, this has all been corrected. And we have seen a steepening of the yield curve. Now, what this chart is showing us is that we have rallied up into the upper band of the declining downtrend channel on the yield curve. And so far this month, while we remain up, we remain steeper on the yield curve relative to last month, we have given up a ton of ground. So it's not looking good. Were we to close out the month right here, right now, this, despite the fact that we closed up on a month, it is not a bullish chart. It's rather bearish because we have a topping tail. We saw a decline in the yield curve. So not good. This sets the stage for a potential rollover. You saw this candlestick last back here at the top of a trading range back in December of 2016. And you saw a rollover, and this is an indicator. If we close out the month like we are right now or worse, not good for the yield curve. Now let's take a look at the 2-year yield curve versus the 10-year yield curve. And you could see that I was talking about this heavily back here when we were flashing a bear flag setup. And then I talked even more about it when we broke this lower band of support. We then inverted, and I've been talking about this with members for a while now, in that history has shown us. Let's pull back on this and let's do a little bit of historical walking down the street, because you're not going to get this on CNBC. We'll go back as far as this chart will take us. and that's back to the 1990s. And this is when I first got into, late 80s, early 90s, when I first got into the markets. And you saw a double bottom setup. It's hard to see here, but we inverted, rallied, pulled back, and then we saw a major steepening of the yield curve. The only problem is that with that steepening of the yield curve, the stock market corrected. It pulled back. Not a major league correction. This wasn't a stock market bubble. It was a correction due to the S&L crisis, and we went into recession. It was a signal by the bond market that we were heading into recession. Sure enough, we did. And fast forward, we saw the second inversion of the yield curve on this chart anyway. The yield curve goes back to the 1950s. And we did not go into recession here. However, when you fast forward to 2000, we had the bubble, the first bubble, the dot-com bubble, of which I was certainly a part of. And while we did very, very good during this run-up, overlaid here in blue is the S&P 500, to show you the inverse correlation of the yield curve of when it steepens and what happens when the stock market begins to roll over during that steepening. So we saw a W formation. You can see the left side here rallied, pulled back, right side of the W, then the steepening, then the stock market rolled over. Fast forward, you saw the same exact thing here. In 2006, you had leg number one to the inversion side. Then we rallied, pulled back, double bottom setup. Then the stock market rolled over as you saw the steepening of the yield curve. Fast forward to what I think is happening right now is that we put in leg one of that W formation, the double bottom setup, and now we're probably going to pull back, set up the right side, and then we will probably see a steepening of the yield curve. What does that mean for stocks? Not good. It means that in all probability, we will be heading into recession. It doesn't mean next week. It doesn't mean next month. But in the coming months, in all probability, after the 2020 election, that is when this economy will be in an admitted recession. When the Federal Reserve recognizes and acknowledges that we have been in a recession, it'll probably be after the 2020 election, which is when they generally find out about recessions. The Federal Reserve never calls a recession until after we're already into it. So I defy anybody out there to point that out. When the Federal Reserve, hey, Danny, how you doing, brother? When the Federal Reserve has called the recession prior to it happening, they won't do it. Oh, so Patrick, you have the 29 strike price. Good for you. And they expire tomorrow. Good stuff. Congratulations. So that's the yield curve. That's the way we're seeing it right now. So more to come on this. We'll watch it periodically as things unfold. And this will help us to identify when we want to get net short of the market. We do have a small short position right now in the small caps. We're going to keep it small right now. No reason to go adding as far as I can see it, despite what the chart of the yield curve is implying right now. So just an observation of the history of the yield curve and how we'll be leveraging it to decide when we want to short this market. And again, it's not going to be this week. It's probably not going to be next month, not heavily anyway. But in the coming months, we will be setting ourselves up to short this market in a very big way. And of course, we'll be alerting members along the way. So members, stay tuned. All right, let's move on to the weekly charts of how we're setting up for the close of the week. We'll begin with the bond market. Always important to touch base on how the bond market looks to identify where we might be heading, especially with our gold mining position and our silver position, because when you see weakness in the bond market, that means yields are rallying higher, and that does not mean good stuff for gold and silver unless we're in hyperinflation or stagflation. Remember when Janet Yellen said, "We fully expect the economy to evolve in a manner in which we don't expect." yeah. Talk about double speak. Yeah, I do. That's funny. Yeah, that's the Federal Reserve for you. It's so important to not listen to what they say. Watch what they do. Watch what they do. So the TLT, we'll begin with the TLT. iShares 20-year bond weekly view. We're up on the week. It's a good week. However, what we're doing here is that we've seen some selling pressure as we rallied up into resistance. So it appears as though we're going to struggle into the week, attempting to try to close out the week at the highs of the week. Forget about closing above resistance. I don't think that's going to happen. We may, for all I know. But the TLT, you're seeing a bit under on the week, but we're setting up for a close off of those highs. Not necessarily good for gold, silver, the miners. So more to come here, members, on the week ahead commentary. On the week ahead commentary, what I do with members is that we do a recap of these charts and our positions on a weekly basis. That way, we go over factual data. How did we close out the week? It's in the books. How do we close it out? How do we want to be positioned for the coming week? The tips. Now, this is something that was very surprising for me to see today, was that we have broken out on a weekly basis on the tips. Now, this is good for our gold mining trade. It's good for gold. It's good for silver. Why? It's because the tips have been a leading indicator for gold and silver, and traditionally they trade in tandem. I'll prove my point here by simply doing an overlay of price performance of gold. We'll overlay it behind, we'll make it gold. We'll pull back to before we go to a monthly chart, let's stick with the weekly chart. And you can see, for the most part, they are tick for tick. Pulling back to a monthly basis. And for those not familiar with what the tips are, Treasury inflation protected securities. Mom and pop generally won't buy tips. Institutions will to hedge their portfolios against inflation that the Federal Reserve doesn't say exists. Think about this. The Federal Reserve says there is no inflation, yet in 2019, we have made new all-time highs. Go figure. So is the market wrong, or is the Federal Reserve FOS? I have to be careful because I'm watching this on YouTube and it's family-friendly commentary you're watching here. So when you take a look here, you could see that the tips were moving higher, breaking out well before gold caught a bid in 2019. So we broke out on the tips here in January of 2019. Gold was struggling, then eventually played catch up to the tip market. Now this week, the tips are breaking out, and we're seeing on a monthly basis a bullish key reversal. So far this month, very positive for the tips. Unfortunately, very negative for the consumer. Why? It's because there's inflation and the Federal Reserve has a war on savers. There's a war on interest being earned by pension earners. And it's not good. It's not going to end well. But they're going to play this game for as long as they can. You must be positioned for the break of this market. Norris, which will we follow, tip or UUP? We'll follow both, Norris, because I like to watch for those not familiar with the UUP, that's the Dollar Bull ETF. And it's a great question. I'll follow both because I'll be looking for inverse correlations. You would assume that when the inflation gauge, meaning the tips, break out to new all-time highs, that's dollar negative. Now, they can trade in tandem for a short while, but it doesn't make sense because you have inflation. That means you have the Federal Reserve right now is just printing money out of thin air. So if you produce something more into existence, you're going to get less value out of it. And that value is going to deteriorate even further as the tips break out to new all-time highs because it diminishes the value of the buying power of the US dollar, especially since we import most of our goods from overseas. So if we want to go buy something out of Europe, a Mercedes, whatever, out of Europe, we're going to be paying in euros with our dollar. So the euro is going to be climbing higher and the dollar diminishing. That's inflationary in and of itself. So that's going to send the tips higher. So while they could trade in tandem for a brief while, logically they shouldn't. They wouldn't normally. So I'll watch it, but otherwise we'll watch both, Norris, to answer your question. Now, this is a chart that everybody should be very, very careful to watch. And I'm going to update this. I saw this earlier. I wanted to do it beforehand. I didn't get a chance. So what we want to do is not that line. Not that line again. Sorry, folks. Okay. So what we want to do here is pay very, very close attention to the transports, the Dow Jones transports, because they have been an indicator, a leading indicator of what the stock market is probably going to do. I mean, the transports were leading the market higher, and they broke out before the Dow Jones did, before the S&P 500 did, and they did so right back here in October. Now what we're doing is, after rallying very, very strong, we are now flirting with a potential. It's not in the books yet, but a potential on a weekly basis, a breakdown below the breakout point. Ideally, for a healthy bull market right now, what we should be doing is pulling back, doing a retest of this breakout point. If we close below this support level, 4 p.m. Eastern Standard Time tomorrow, this market has problems. At current, let's just say, let's be conservative, we're at support, right? We're not going to be doom and gloomers here. We're at support. We'll see what happens. But on a weekly basis, I would be very concerned about the Dow transports. If they close at the lows of the week, that's a problem, because the lows of the week will bring us down below key support. That's a bull trap. That's a breakout point failure. Not good. So be forewarned. The Dow Jones. We did put in a weekly high here. However, we could not hold our mud. I got to pick up steam here because we're running out of time. Dow Jones did not hold its mud this week. We are now flirting with the lows of the week. Not what you want to see. RSI is pulling back. We'll retest support. We'll see whether or not that holds. Volume to the downside is light this week. So this is not an indicator of institutional selling. No doom and gloom here. Just an observation. The S&P 500 weekly chart. Very similar to the Dow Jones. Very light volume. Again, this is not a screaming short week, you know. It's a down week. That's all I'm going to say about it. No reason to go, despite my commentary with regard to the yield curve, despite my commentary with regard to the VIX. No reason to go becoming a net short of this market. Why am I being so cautious? It's because a couple of reasons. One, the trend is still up. I may be a contrarian, but that doesn't mean I swallow the Kool-Aid and say, all right, I'm a contrarian. I need to short the market when the market's near all-time highs. That's ridiculous. The trend is still higher. In all probability, we're going to head higher here into the 2020 elections, and that's why I wouldn't be a net shorter of this market. To short the market right now is betting against power, and you can see through the manipulation of the currency and interest rates right now, power is in control, man. Power is in control of these markets. The semis. Here's the problem. The semis took out last week's lows. Now, the semis have been leading this market higher. They are now lagging the market. That's a major problem. So we are very close to the lows of the week. We don't have much in terms of support below. Volume to the downside is light. So really just an observation. I don't like the fact that we took out last week's lows. If we rally to close back above last week's lows, okay, it was a pullback. We rallied back. That's why we don't short the market intra-week. We want to wait until Friday. Let's see how this market closes. If we see a major breakdown and we're piercing, like on the Dow transports, if we break down below this key support level on a weekly basis, then we would start looking to short the transports. We're not there yet. All we're doing is doing our homework. Simple as that. Healthcare. We were long of healthcare. I've been getting teased by members that they stayed long. I booked profits early. You know what? Okay. I'm glad that they're making money. Good for them. I made some money, not as much as I wanted to. Healthcare is looking good. in all probability, we will continue higher. The only caveat I'm going to throw out here is that on a weekly basis, we are just off the third standard deviation Bollinger Band, trading above the 2. We could stay there. That doesn't mean go selling your position. I mean, we stayed up there for several weeks in the past, but this is getting a little bit extended right now. So if you have profits, you want to tighten up your stops, that's what I would think about doing here. Members, if you want to talk about this in the private group session on daily or intraday basis, bring it up. I'll go over all your requests on the private group session, 7 p.m. tonight. And again, I'll send out a link in a few minutes when we wrap up here. And folks, if those joining in, if you could please click the like button, it helps me out with the YouTube algorithm. I'd really appreciate it. And subscribe to the channel and click that bell button to get notified in the future. Thank you very much. I appreciate it. So moving on. The utility sector. Doji star formation on the week, a sign of indecision. Anything could happen here. So in a situation like this, Stokes are really weakening up here. In a situation like this, what I like to do is simply take my crayon out. I love these guys out there that divine what the chart's going to do, yet they don't annotate and set rules. And were somebody to ask me, hey, Bob, the utilities, are they a buy or a sell? Anecdotally, I can give you my opinion on what's going on with the Federal Reserve and whatnot. But what we want to do is identify where there are sellers and whether or not we have the rocket fuel to close above resistance. And thus far this week, we have not. So my answer to somebody that's looking to buy the utilities right now is avoid them right now. Let the utilities prove themselves worthy of being bought. Now, if you see yields pull back, that is bullish for utilities because you have fund managers out there chasing yield, any yield whatsoever. And they'll buy the utilities, they'll pay up for it, and that'll be a good thing. So watch for a breakout above this upper band of resistance or a pullback to support. Watch for W formation to form. Other than that, I wouldn't touch them right now. Santiago, Bob, I like your show, sir. Thank you very much. That's very kind of you. Appreciate that. That means a lot to me. Thank you. I love feedback, negative or positive, and I accept it. I really do. So thank you very much for that. Moving on. Housing. So housing is under pressure again, probably because yields rallied today. Out of curiosity, I want to see how they did on a daily basis because you had yields weak for the most part, most of the week. They did move up higher today, and yeah. So what happened here is this was a reaction. This is a daily chart now of the housing sector, HGX. And we were vacillating all week. No real bid under housing. And remember Home Depot. That certainly is a factor here as well. So no real bid under housing this week, even though yields were pulling back. Now, today, with yields rising, you saw housing taking on the chin. I would avoid this sector like the plague. This is sending you a signal right now. And RSI is weakening up here in a very, very big way on a daily basis. Avoid housing. Avoid it. Okay. You're very welcome, Santiago. Thanks for joining. Appreciate it. I love the way you explain things out for the little guy. Great stuff. Thank you. I was one. I believe me, I was one, pal. Thank you very much. Appreciate that. Oil. All right, so oil, we spoke about this morning, as a matter of fact. There was a gentleman on Swing Trading today, which I produced 5 a.m. Eastern Standard Time, Tuesdays through, usually on Fridays, but definitely Tuesdays through Thursday. So this morning, a gentleman was saying, he was betting on oil going down to $52 a barrel. And I warned you, I said, you know what? Be a little bit careful there because there's a couple of things going on here. The weekly chart is firming up. It wasn't at the highs of the week, but it was firming up. And you also have the president he's in the camp of the oil companies, meaning he wants a bid under the price of oil. Why? It's because the fracking sector is the highest paying sector of the economy. And guess what? They vote Trump. You have a weak price per barrel of oil. You see layoffs in the fracking sector, not good for the president. So there will be a bid under oil. And what happened today? Oil turn positive on the week, and we have a bullish key reversal bar on the week. And in all probability, we are going to break out here on oil. You have Stokes moving up higher, weekly basis, they're back above 50. Very bullish stuff going on here. Don't bet against oil. Don't bet against energy. And speaking of energy, I like this chart of the energy sector, weekly basis. Again, I want to see how it closes out on Friday. Members will talk about strategy on the weekend, how we want to be positioned going into the next week. But energy on a weekly basis, what we have here is a very close to, not a bullish key reversal bar. A bullish key reversal is when you're down on the week, you reverse to close positive and at the highs of the week. We're not there yet. However, we have a very bullish reversal bar, not a key reversal, a bullish reversal bar in that we were down significantly on the week. We were down below support. We made new weekly lows. What did we do today? We rallied and we closed back above resistance. Very, very important. Will it close there by Friday afternoon, 4 p.m.? I don't know. The markets will tell us. So we'll talk about this more and potentially getting long of the markets, because what did the markets do this week vis-a-vis energy and oil? What they did was they said, hey, start taking a look, because I just gave you a gift. And that gift is, they told us where there are buyers below to support the sector. On the IXC, the low of the week was 30.60. You know to put your stop loss right below that level if you buy it tomorrow. On the oil, what happened here? What happened here? What happened to my chart? Okay, what happened here? The market sent us a signal. The low of the week was 11.52. What do? You set your stop loss right below that level, because if we break it, that's bad stuff. That means very, very dire consequences for these sectors. So all good stuff. This is the value of looking at the weekly charts. The banks, weekly basis. Now, what we're seeing set up here are potential problems for the banks. I still happen to like the banks because despite the fact that yields are lower on the year, the banks are higher. Traditionally, that doesn't happen because of net interest margins. So I won't elaborate on that right now. But you're seeing some weakness in the banks last week, this week, but they're holding their gains despite the fact that yields have been lower. So the banks, I wouldn't short them. I might not buy them. I have to do a little bit more deep dive of analysis on the daily charts, intraday charts, and I want to see how we close out the week. But the banks are holding in there, and they're worthy of more analysis. I'll put it to you that way. So members, more to come. Let's talk a bit about emerging markets. Now, emerging markets will at some point in time do very, very well. Anthony, hey, Anthony. Hey, Bob, how are you? Doing well? Thank you, man. Hope you're doing well, too. I am on an exercise. I am on an exercise by watching you. My wife wants to wants me to say hi, stay trim. Oh, your wife wants to say trim. Okay, my glasses are foggy. You got a good wife there. Good for you. Okay. That's an excellent behavior. All right, good stuff, Ant. Thanks for that. I love live streams. Good stuff. So, emerging markets. Okay, so I have a grand plan for emerging markets. They don't necessarily fit in with our strategy right now. Traditionally, emerging markets do well with a weak US dollar. Why? Because emerging markets are heavily in debt, usually, right? They're kept in debt, right? We did it to the emerging markets. The Chinese do it now. It's so that we can get their assets, right? The Chinese are masters at it. They're doing it all over Africa. They're doing it all over Asia. So they're heavily in debt. The problem for emerging markets is that their debt is denominated in US dollars. So when the dollar weakens, their debt becomes more affordable. So I wouldn't be a buyer of emerging markets right now because they're trading with the market overall. When I would be a buyer of emerging markets is when the dollar tanks, and it will. It will. The Federal Reserve is making sure of it. And when that happens, you'll see, ultimately, when this market rolls over, you're going to see emerging markets roll over. And be warned, be forewarned here. EDC, which is a symbol I'm tracking, I did the analysis on this, is 20% China. I do not like the Chinese market. you had the major, and this I should have brought up this article earlier. I'll go over it tomorrow on Swing Trading Today if I remember it. Their number one, the number one stock globally, which is up like, I don't know, thousands of percent over the past 10 years, blew up today, dropped by 90%. It's a Chinese, it has to do with the Chinese mortgage market. And it reminded me, I got goosebumps on my arm because it reminded me of Countrywide Financial. Look that up. They were bought out by Bank of America because the Federal Reserve told them to, right before everything blew up during the financial crisis. So I'll bring up that article. Join me tomorrow morning on Swing Trading Today. Again, get notified, click the like button and click the subscribe button, and you get notified when we go live. If you're up at 5 a.m., you can also catch the replay. So EDC, getting back to this, is 20% China. Beware. I am very bearish on China for multiple reasons. I won't go into it now, but I want to see a break of the US dollar, and I want to see the stock market roll over. And when the EDC trades along with it, I think that the first round of buying that I will be doing is not US stocks. It'll be emerging markets. That will be the phoenix that rises out of the ashes of the upheaval that we're going to see when ultimately this bubble breaks, and it will break. So, and I've been there twice, 2 times. So one I didn't expect, I was too naive, I was too young. The second one I fully expected, and we did very, very well. We plan on doing the same this time around. So please join us. Hey Sam, how you doing, brother? Close short on Cat Bob, around 140. Luckily today, reverse. I am not wrong. Cat, you booked a profit on Cat? Yeah, it rallied off the lows. This is a weekly chart, but it's off the lows of the week. Oh, yeah. It could be a short covering rally, but worthy of a close of trade. I think that I think that ultimately this is going to be a short covering rally, but I think you were wise to cover your short. So congrats if you made money. Good for you, Sam. Glad to see that. All right, with that, folks, we're gonna shut it down. We have a lot of people here tonight, and thank you for joining in. Thanks for spending your Thursday night with us. Please click that like button, and members, I will send out a link for the private group members inner circle. That begins at 7 p.m. We'll go over the symbols that you want me to talk about and some of our positions as well. So I'll see you there. Watch for the link in your inbox within the next few minutes. And everybody have a great night and have a profitable trading week and a great weekend. And a happy Thanksgiving if I don't see some of you who are checking out early for the holiday. Be well. Have a great night.